Hi, I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. Today's topic on our Back to Basics series is passive exchange traded funds, or ETFs. The value of the global ETF market has gone from around $417 billion in 2005 to about 7.7 trillion US dollars in 2020, according to Bloomberg. At its core, an exchange-traded fund is very similar to other pools of capital, like mutual funds or closed-end funds. It is a collection of investments that trade as a basket on a stock exchange. This collection can be anything from stocks or bonds to things more esoteric, like futures and commodities. There are two broad categories for an ETF, passive and active. Today we're going to talk about the passive. When people think of an ETF, they often think about this passive version that tracks the index. These securities are very cheap to manufacture, and most of them track the underlying index very closely. An example of this is the S&P 500 Index ETF. This investment tracks the 500 companies that make up the S&P 500 index. How much of each company it owns is based upon the market value of the underlying company. This means that the world's largest companies, like Apple and Amazon, make up the largest percentage of the companies in the index. It's a passive index because it tries to follow the index weightings almost exactly. There's no stock picking involved, and investors should expect to receive a return very similar to the index. Less costs, of course. Many investors like this type of ETF since it attempts to ensure that your return will not deviate from the overall market returns in any significant way. Starratt Wealth Management has been helping successful families transition through life events for over 28 years. If you'd like to know more, please reach out.